everyone. Welcome to Opulent Savvy, the channel where we help you achieve your financial goals and dreams. In today's video, we are going to talk about how to build wealth through the stock market. You might be wondering why we chose this topic. Well, according to Google Trends, the search term stock market has been trending in the past year, especially after the pandemic hit. This shows that more and more people are interested in learning about investing and making money from stocks. But maybe you are thinking that the stock market is not for you. Maybe you think that it is too complicated, too risky, or too expensive. Maybe you think that you need a lot of money, education, or experience to start investing. Or maybe you think that it is too late for you to join the game. Well, let me tell you something. None of these things are true. The stock market is for everyone who wants to create wealth and achieve financial freedom. It doesn't matter how old you are, how much money you have, or what background you come from. All you need is a willingness to learn, a plan, and a mindset. In fact, some of the most successful investors in history started from nothing. They came from humble backgrounds, faced many challenges, and overcame many obstacles. But they didn't give up. They kept learning, growing, and investing. And eventually, they became millionaires or even billionaires. Do you want to know how they did it? Do you want to learn how you can do it too? Then keep watching this video because we are going to share with you some of the best tips and strategies on how to build wealth through the stock market. Understanding the stock market. Before we dive into the details, let's first understand what the stock market is and how it works. The stock market is a place where buyers and sellers trade shares of companies. A share is a unit of ownership in a company. When you buy a share of a company, you become a part owner of that company. The price of a share depends on the supply and demand of the market. The more people want to buy a share, the higher its price goes. The less people want to buy a share, the lower its price goes. The price also reflects the performance and expectations of the company. The better the company does or is expected to do, the higher its price goes. The worse the company does or is expected to do, the lower its price goes. The goal of investing in the stock market is to buy low and sell high. That means you want to buy shares when they are cheap and sell them when they're expensive. That way, you can make a profit from the difference between your buying and selling prices. But how do you know when to buy and when to sell? How do you know which companies to invest in? How do you know how much to invest? These are some of the questions that we will answer later in this video. But before that, let's talk about why investing in the stock market is one of the best ways to build wealth. Starting from scratch, steps to building wealth. Investing in the stock market has many benefits that can help you create wealth and achieve financial success. Here are some of them. Investing in the stock market allows you to participate in the growth and innovation of various industries and sectors. You can invest in companies that are leading or disrupting their fields, such as technology, healthcare, energy, consumer goods, etc. Investing in the stock market gives you access to a global market with thousands of opportunities. You can invest in companies from different countries and regions, such as US, China, India, Europe, etc. Investing in the stock market enables you to generate passive income from dividends and capital gains. Dividends are payments that some companies make to their shareholders as a way of sharing their profits. Capital gains are profits that you make when you sell your shares at a higher price than what you bought them for. Investing in the stock market helps you beat inflation and increase your purchasing power. Inflation is the rise in the general level of prices over time. It reduces the value of your money and makes things more expensive. By investing in stocks that grow faster than inflation, you can preserve and enhance your money's value. But how do you start investing in the stock market if you have little or no money? How do you go from rags to riches? Here are some steps that can help you. Step 1. Set clear financial goals. The first step to building wealth is to set clear financial goals. You need to know what you want to achieve with your money and why. For example, do you want to save for retirement, buy a house, start a business, travel the world, or support a cause? How much money do you need to achieve your goals and by when? Having clear financial goals will help you stay focused, motivated, and disciplined. It will also help you measure your progress and adjust your plan if needed. Step 2. Budget and save money. The second step to building wealth is to budget and save money. You need to know how much money you earn and how much money you spend. You need to track your income and expenses and see where your money goes. You need to identify your needs and wants and prioritize your spending accordingly. The key to budgeting and saving money is to spend less than you earn. That means you need to either increase your income or decrease your expenses, or both. You can increase your income by getting a raise, finding a side hustle, selling your skills or products, etc. You can decrease your expenses by cutting unnecessary costs, finding cheaper alternatives, negotiating better deals, etc. The more money you save, the more money you can invest. You should aim to save at least 10% of your income every month. You should also have an emergency fund that can cover at least 3 to 6 months of your living expenses in case of unexpected events. Step 3. Explore different investment strategies. The third step to building wealth is to explore different investment strategies. You need to know how to invest your money wisely and effectively. You need to understand the different types of investments, such as stocks, bonds, mutual funds, ETFs, etc. You need to know the pros and cons of each investment and how they fit your goals, risk tolerance, and time horizon. There are many investment strategies that you can choose from, but here are some of the most common ones for beginners. Dollar cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the market conditions. This way, you can reduce the impact of market fluctuations and buy more shares when they are cheap and less shares when they are expensive. Index investing. This is a strategy where you invest in a basket of stocks that track the performance of a specific market index, such as the S&P 500, the NASDAQ 100, or the Dow Jones Industrial Average. This way, you can diversify your portfolio and capture the returns of the entire market with low fees and minimal effort. Value investing. This is a strategy where you invest in stocks that are undervalued by the market. These are stocks that trade below their intrinsic value or have strong fundamentals but are overlooked by investors. This way, you can buy quality companies at a bargain price and profit from their future growth. Step 4. Research and select stocks to invest in. The fourth step to building wealth is to research and select stocks to invest in. You need to know how to analyze and evaluate different companies and their stocks. You need to look at their financial statements, such as their income statement, balance sheet, and cash flow statement. You need to look at their key metrics, such as their revenue, earnings, growth rate, profit margin, return on equity, debt-to-equity ratio, etc. You also need to look at their qualitative factors, such as their competitive advantage, customer loyalty, brand recognition, innovation potential, social responsibility, etc. You should also look at their valuation ratios, such as their price-to-earnings ratio, price-to-book ratio, price-to-sales ratio, etc. These ratios help you compare the price of a stock with its earnings, book value, or sales. They help you determine if a stock is overvalued or undervalued by the market. You should also look at their dividend history and yield. Dividends are payments that some companies make to their shareholders as a way of sharing their profits. Dividend yield is the annual dividend divided by the current share price. It tells you how much income you can expect from a stock. You should also look at their future prospects and growth potential. You should consider their industry trends, market opportunities, competitive threats, regulatory changes, etc. You should also consider their future earnings estimates and projections. You should also look at their technical analysis and chart patterns. Technical analysis is the study of past price movements and trends using various tools and indicators. Chart patterns are formations that appear on the price charts that indicate possible future price movements. You should use a combination of these methods to research and select stocks that match your investment criteria and goals. Growth mindset and persistence. The fifth step to building wealth is to develop a growth mindset and persistence. You need to have a positive attitude towards learning and improving your skills and knowledge. You need to embrace challenges and failures as opportunities for growth and feedback. You need to seek advice and guidance from experts and mentors who can help you along the way. You also need to have persistence and patience when it comes to investing in the stock market. You need to understand that investing is a long-term game that requires discipline and consistency. You need to stick to your plan and avoid emotional decisions based on fear or greed. You need to ignore the noise and distractions of the market and focus on your goals. You also need to learn from your mistakes and successes. You need to review your performance and results regularly and see what works and what doesn't. You need to adjust your strategy and tactics accordingly and keep improving your skills and knowledge. One of the best ways to develop a growth mindset and persistence is to learn from the stories of successful investors who started from scratch. Here are some examples of such investors. Warren Buffett. He is one of the richest and most respected investors in the world. He started investing at the age of 11 with $120. He learned the principles of value investing from his mentor, Benjamin Graham. He built his fortune by buying undervalued companies with strong fundamentals and holding them for the long term. He is the chairman and CEO of Berkshire Hathaway, a conglomerate that owns dozens of businesses, such as Coca-Cola, Apple, Geico, etc. Peter Lynch. He is one of the most successful mutual fund managers of all time. He started investing at the age of 13 with $1,000. He learned the concept of buy what you know from his mentor, Fidelity Investments founder Edward Johnson. He built his reputation by investing in companies that he understood and liked, such as Dunkin' Donuts, The Gap, etc. He was the manager of the Fidelity Magellan Fund, which achieved an annual return of 29% from 1977 to 1990. Cathie Wood. She is one of the most influential and innovative investors in the world. She started investing at the age of 18 with $5,000. She learned the importance of innovation and disruption from her mentor, Arthur Laffer, a renowned economist. She built her vision by investing in companies that are leading or disrupting their fields, such as Tesla, Roku, Square, etc. She is the founder and CEO of ARK Invest, an investment firm that focuses on disruptive innovation. Strategies to accelerate wealth building. The sixth step to building wealth is to use strategies that can accelerate your wealth building process. You need to know how to leverage the power of compound interest, diversification, and other investment vehicles. Compound interest. Compound interest is the interest that you earn on your initial investment plus the interest that you earn on your interest. It is one of the most powerful forces in finance that can help you grow your money exponentially over time. For example, if you invest $10,000 at a 10% annual interest rate and reinvest all your interest, you will have $25,937 after 10 years, $67,275 after 20 years, and $174,494 after 30 years. That's a huge difference from just earning simple interest, which would give you only $20,000 after 10 years, $30,000 after 20 years, and $40,000 after 30 years. The key to maximizing compound interest is to start investing as early as possible, invest as much as possible, and invest for as long as possible. The longer you let your money compound, the faster it will grow. Diversification. Diversification is the practice of spreading your money across different types of investments that have different levels of risk and return. It is one of the most effective ways to reduce your risk and increase your returns. The idea behind diversification is that not all investments perform well or poorly at the same time or in the same way. By having a mix of investments that are not correlated or move differently from each other, you can balance out your losses with your gains and smooth out your returns over time. For example, if you invest all your money in one stock or one sector or one country, you are exposing yourself to a lot of risk. If that stock or sector or country performs poorly or faces a crisis, you could lose a lot of money. But if you invest in a variety of stocks or sectors or countries that have different characteristics and prospects, you can reduce your exposure to any single source of risk and benefit from multiple sources of growth. The key to diversification is to have a well-balanced portfolio that reflects your goals, risk tolerance, and time horizon. You should have a mix of stocks and bonds that suit your needs and preferences. You should also have a mix of domestic and international investments that give you exposure to different markets and economies. Other investment vehicles. Other investment vehicles are other types of investments that can help you diversify your portfolio and enhance your returns. Some of the most common ones are index funds. These are funds that invest in a basket of stocks that track the performance of a specific market index, such as the S&P 500, the NASDAQ 100, or the Dow Jones Industrial Average. They offer low fees, high diversification, and consistent returns. ETFs. These are funds that trade like stocks on an exchange and can invest in a variety of assets, such as stocks, bonds, commodities, currencies, etc. They offer flexibility, liquidity, and transparency. Cryptocurrencies. These are digital currencies that use encryption and blockchain technology to facilitate transactions and store value. They offer innovation, disruption, and high potential. These are just some of the examples of other investment vehicles that you can use to accelerate your wealth building process. You should do your own research and due diligence before investing in any of them. Navigating market fluctuations. The seventh and final step to building wealth is to navigate market fluctuations. You need to know how to handle market volatility and downturns. Market volatility is the degree of variation in the price of an asset or market over time. It is a measure of risk and uncertainty. Market volatility can be caused by various factors, such as economic news, political events, natural disasters, investor sentiment, etc. Market fluctuations are inevitable and unavoidable. They are part of the nature and cycle of the market. They can be scary and stressful for investors, especially for beginners. They can also create opportunities and challenges for investors. The key to navigating market fluctuations is to have a long-term perspective and a rational approach. You should not let your emotions or impulses dictate your decisions. You should not panic or overreact to market movements. You should not follow the crowd or chase trends. By following these steps, you can navigate market fluctuations with confidence and ease. That's it for today's video on how to build wealth through the stock market. We hope you enjoyed it and learned something valuable from it. If you did, please give this video a thumbs up and subscribe to our channel for more videos like this. Also, don't forget to hit the notification bell so you don't miss any of our future uploads. And if you have any questions or comments, please leave them below. We would love to hear from you and answer them. Thank you for watching Opulent Savvy, and we'll see you in the next video. Until then, happy investing!